Hey, Roland, it is a pleasure today. I am here at PRMG with Ro, the Mortgage Pro. And when I tell you that he's got a lot of nuggets to drop on you today, I am telling you he's got a lot of nuggets. So get ready, get set. We are about to go with the Mortgage Pro.
Well, thank you, Bridget, for inviting me today. And I'm so happy to be on your podcast. How are you today?
I am wonderful.
Good.
I have been talking about financial literacy.
Yes.
And this is something that our people and most people in the world have not been taught. So when it comes to the housing market, I'm a realtor, you are in mortgage loan.
Yes.
I want you to first tell me a little bit about yourself, how you got into this, what, fuels you to do what you do, and why you feel it's important for people to know the difference, because there's a process to having mortgages or to getting a mortgage for a home loan. So those are just three areas that I'm going to talk to you about. Okay. You can start first with just telling us a little bit about yourself.
Very good. So once again, my name is Roland Daniels. I've been with PRMG now for 2 months. I've been in the mortgage industry since 2005. The reason I got into the mortgage industry was due to my parents. My parents was in the process of buying a home and getting financing. And I just wanted to make sure that they weren't being taken advantage of. That during that time, there was some issues going on that maybe they were going to be put in a loan that was not right for them, or maybe they're being overcharged. Mm-hmm. And so I made a commitment that I would join the mortgage industry, and it worked out. I love it. I've always been a numbers person. Born and raised right here in Las Vegas, Nevada. Went to Mabel Hogard, Gibson, Western, CSN, Western, and I love what I do. Every day, I get to help people achieve the dream of owning a home, and this is what I do.
And I love it when I meet a Nevadian, because you guys are the history books.
Yes.
For this town. You've been here when it was truly desert.
Yes.
All right, so I love it.
So where I am now, which is on Durango and Sahara, it was all desert growing up. I think the farthest we would be able to go is probably somewhere around Durango. Other than that, it was all desert, owned by the Bureau of Land Management. But Las Vegas has grown. If we knew what we knew now, we would be buying property.
Yes.
30 years ago.
30 years ago, I would have been out here buying land. Like Howard Hughes,
yes.
Smart man. And that's another story for another time.
It is.
Yes, very smart man a long time ago. So please, people, pay attention, because purchasing land is just as important as purchasing a home. So pay attention.
It is. So creating your wealth starts with home ownership. It's definitely one of the first steps and the building block to having your own wealth. Instead of paying someone else's mortgage, why not pay your own? One way or another, whether you're paying rent, you're paying the landlord's mortgage, but you might as well buy and pay your own mortgage. And just like Bridget said, financial literacy was not taught in school. Of course, we had shop class, or maybe we had home economics.
Yes.
Instead of teaching us the importance of building credit, understanding a budget, how your cash flow works, those are the things that we needed to show us how to live, or the things that are important in our life.
To make life easier.
Yes.
And to establish a credit profile, which is primarily what fuels and allows us to be able to leverage how far we go in life, what we can have in life.
And just like I tell everybody, a mortgage is a tool. It's a way to leverage other people's money to purchase a home. Because most of us don't have $400,000 or $500,000 in the bank. but we do have the ability to get a mortgage and using someone else's money.
Yes.
We only need 3.5% down. So maybe on a $400,000 mortgage, we only need 13 or 14,000 instead of 400,000 or 500,000. So it's a tool that can be used to purchase a home. And like I said, it's the first step in building wealth.
So when we talk about steps, if you could just give us an overview of the steps for the mortgage process that are important for first-time home buyers, even those who refinance their home, or those who have the work history but have never even thought about it because they've been renting for so long. Because we have people that have been renting for 20 years or more, and they've never thought about it. They've just been comfortable, and now they've decided, I want to own something.
That is correct.
So
I've had clients that just this year, as rent has been increased. So your rent may have been $1,200 maybe 5 years ago. Now it's close to $2,000.
Mm-hmm.
So I've had borrowers who will come in and they say, well, my rent is going up. Maybe starting October 1st, it's going up $400. Now my rent is going to be $1,800 a month. Before then, I never thought about purchasing a property. I've always been renting. I've had some borrowers who have been in the same apartment complex for 20 years. Yeah. So they've been making all of these payments to the landlord. And if you were to add them up, they've probably made $150,000 to $200,000 worth of rental payments.
Bought a $500,000 property.
Yes. So now is the time. The first step, even when you meet with a realtor, they're going to ask you, have you been pre-approved? And a pre-approval process means that you've met with a lender and you've supplied your documentation. We'll usually ask you in twos. So we'll need your last 2 years of bank statements, not last 2 months of bank statement, last 2 years of tax returns, W-2s, so forth. That's just the basics. If you're self-employed, we'll need your last 2 years of self-employment tax returns along with your personal returns. And then we'll need a profit and loss statement, just a little bit of difference between the two. What else?
And then after the pre-approval, what would be the next step that they might need, or what would be some nuggets that you might throw to them not to do if they are pre-approved for a home? Because some people don't realize, they get excited, I've been approved.
Yes. So
they start thinking about things that they may want. What are some things that they should not do?
Perfect. But let me go back. So there's a difference between a pre-approval and a pre-qualification. Pre-qualification stage is just you called up a lender, you told them, how much do you make? What are your credit scores that you thought that was your credit scores?
Through Credit Karma.
Right, or Credit Sesame.
Yes.
I get that question every time. So when it comes to a pre-qualification, it's just a simple phone call. You've given me the details, how much you make, what are your debts, and what are your FICO scores are, and I just do a quick calculation. You need a pre-approval. Pre-approval means that we requested documentation from you, and then we submit it to an underwriter to get a full underwritten loan, which means that when I give that pre-approval letter to your realtor, you're good as gold. You're just become a cash buyer, and we can close as little as 2 weeks. So you are ahead of the game. You know where you stand. You've already been pre-approved by an underwriter. You want to be pre-approved by an underwriter, not just a pre-qualification stage.
Thank you for clarifying that. One other thing I'm going to ask you to clarify too, while we're right there, putting a pin in it, the difference between Credit Karma, Credit Sesame, Equifax, not Equifax, Experian is the one people like to use.
Yes.
And the number or the credit score that you need to get pre-approved.
Perfect. So the question comes up every day with clients. Well, my Credit Karma, Credit Sesame score says I have 780. And they get these updates on a weekly basis. Mm-hmm. Well, when it comes to true FICO scores, they only update once a month.
Once a month.
In the mortgage industry, we pull what's called a tri-merge credit report, and that comes from the FICO scoring system. There are thousands of models out there. So the mortgage industry has theirs, the auto industry, credit cards, installment loans, insurance, they have all credit scoring models. We use a mortgage credit model. When you look at Credit Karma, Credit Sesame, those are more educational scores that'll give you an idea of where you are, and not your actual scores.
Yes.
So Credit Karma and Credit Sesame just gives you an idea. The point difference can be anywhere between 20 and 60 points.
Thank you for clarifying that. I do try to help people understand that there is a difference. And so you were very clear in how that difference is through each phase of what you're trying to purchase, whether it's a home or a car or just getting a credit card, which is a revolving credit line. So, or the car is the revolving credit line.
Yes.
Okay. So there is a big
An auto loan and mortgages are considered installment loans. Credit cards are considered revolving credit, which means you make a payment every month and that amount can change on a monthly basis depending on how much you spend and how much you pay off. Whereas a car payment, you start off, maybe that car is at 40,000 and every month a portion goes towards the principal and the rest goes towards the interest in the purchase of that vehicle or auto, vehicle or your home loan. It works very similar, including HELOC, which is a home equity line of credit as well.
Yes. So thank you for putting that in there and explaining that, because that is a key piece that people do not understand and they are stuck. Credit Karma told me that this was my credit score.
Yes.
And so I appreciate you taking the time to go ahead and clarify that.
But you can use Credit Karma and Credit Sesame. Like I said, that'll give you a general idea of where you are. And also use the credit monitoring service that's provided for free.
Yes.
It'll let you know if someone's made charges on your credit that you've never seen, or it's just use it as a monitoring service. Tool.
Yeah. And working toward getting your credit scores up if they need to be built up.
Okay.
Understood. Got it. Next, you were going to go into after the pre-qualification, then the next step of what they would need or what they should not do prior to the purchase of a home.
So please do not go out and charge your credit card. Don't change your spending behavior. Don't go out and buy furniture. Don't go out and buy a new car. Please do not go out and co-sign for anyone. So I've had situations where the borrower wanted to see a brand new car in the driveway. So as we were going through the home loan process, we haven't closed yet, but we're a week away. They decided to go purchase a car and so they can have a brand new car in the driveway. Well, right before closing, the lender will usually run your credit report again, a soft pull, and then they will re-verify to make sure you're still employed. Well, if your credit behavior changed or you've added new trade lines, that affects your debt to income ratio. That could now make you ineligible and they will definitely cancel the loans.
Yes.
So sometimes you have to make a choice. Do you want to live in a car or do you want a home?
Okay. And when we talk about debt to income ratio, that is important. Your debt, along with the new mortgage that you're going to take on, have to fit within the income that you bring in every month.
That is correct.
People don't realize that. You know, we call it DTI because we know it. We explain it to them as debt to income. And they still don't realize that knowing what your monthly income is and knowing, because that's what comes in, knowing what's going out of that, utilities,
just as important,
insurance, car payments, mortgage payments, it's crucial.
It is.
And it makes the difference for some in getting a house. I have, a situation where I'm working with a client, very sweet client, and it was hard for me to explain that even though you have a great job, you have a car payment that's exorbitant.
Yes.
And it needed to be refinanced so that we could fit that into the monthly budget to be able to take on a home loan. Home loans, home mortgages right now are not $400 or $500.
No, they're not.
We are at a different time and place, and so I'm trying to get people to understand that, and that's really been a hurdle for me with the debt to income and them. So that's why I wanted you to talk about what not to do.
Yes. So when it comes to interest rates, they were on sale the middle end of 2021. They're no longer on sale. We're going towards a more normalized market where home prices are only appreciating 5 to 10% instead of 30% year over year. Things have changed. So when it comes to interest rates, they may seem a little bit high now. We're around anywhere between 5.5% to 6.5%, depending on your FICO scores, and we'll go over that as well. But keep in mind, just like Bridget was saying, when it comes to qualifying for an FHA loan, you need a 580 FICO score to put down 3.5% down on a home. We'll go down to a 500, but for FHA qualification, any score between 500 and 579, you would have to put 10% down, which is huge. It's a big difference. On a conventional loan,
and I want to just jump in.
Go ahead.
It's 10% of the loan amount.
Yes.
Which is the amount of the home.
Yes.
Okay.
So if that home, for an example, if that home is 300,000, I need to put 10% down.
That's $30,000.
Yes. Compared to just 3.5%, which is about
3,000.
11,000.
11,000.
Big difference.
Forgot you the number.
Yes. But we can do down payment assistance programs if you're eligible to help you get into the home. But remember, there are no homes that you can get in with zero down.
No zero down homes. That's for them to get your information, to get you in the office, to get you to talk to them so they can start sending you emails, text messages, and phone calls. No zero down.
There's closing costs involved. Inside of those closing costs, there are title fees. You have to pay for an appraisal, a home inspector. These are all additional fees you have to pay. So a rule of thumb, whatever home price that you're looking at, if you multiply that by just say 7%, just to make it easy, then you know where you are. If it's 300,000, you need about 21,000, and that should cover everything. Whether you need an HOA, that'll cover the taxes, insurance, and everything else associated with it. But it gives you a great idea.
Okay, that's good to know. So looking and going forward, use the calculation of 7%.
7%. Make it easy.
And that will give you a rounded approximate figure of how much money you need on hand before we can go house shopping.
Yes. Just remember, with a conventional loan, those are terms you will hear, Fannie and Freddie. So typically on a Fannie, conventional, and Freddie, you need a 620 minimum FICO score. When it comes to FICO score, we pull credit from all three bureaus, which is called a tri-merge. The three scores come from Equifax, Experian, and TransUnion. So we look at all of the borrowers on the application. We take the middle lowest score.
Okay.
So if it's me and my brother, I have a middle score of 800 and my brother has a middle score of 600, then we have to use the credit score of my brother for the entire loan.
Now you just taught me something. I always assumed they would take the higher score.
Nope, it's the lowest of all of the parties on the application.
Oh, okay. All right. So if you are a couple and you begin the process of working on your credit to be able to get a home loan, or even if it's a car loan, go ahead and make sure you're both working. Get a Social Security number. You should have it anyway. You should have had it when you got married. Type that thing into the Credit Karma and the Credit Sesame, same thing that you're using, and monitor his credit. And that's something that you work at together. That's part of marriage. I'm sorry. That's another conversation. We'll get that one on Get Sucker Free with the Marriage 101.
Yes. And let me drop two nuggets. I would say the quickest way to bring your scores up, one, is to make sure you keep your credit card balances at 30% or below your credit limit. For an example, I have a credit card limit of $100. I don't want to exceed $30. Or if it's $1,000, I don't want to exceed $300. As long as you keep that 30% or below, the credit scores and the scoring models in your favor. Once you exceed 50%, they start to take away some of your good credit scores, and they just chip away at it. And you don't want that. You want the best credit scores possible when you apply for a home loan.
I need that.
Number two, if you have the ability, maybe a family member or a friend, you can be added to one of their cards as an authorized user. But please make sure that they're also keeping their card at 30% or below, and they have great credit. If they have great credit, you can ride their coattails. Thank you.
Their credit card tail.
Yep. And then that'll help your scores increase. Those are two of the quickest ways that we can improve credit. Even when you go to a
So those are two nuggets that you just received on how to build your credit quickly. And so don't forget, you need to keep your credit score under 30%. And as well, if you have the ability to have a good friend or a family member that has great credit, you don't have to get the credit card. Let them know that. I don't need the credit card. I just need you to add me. As long as your name's on there, it's reporting on your credit report as well as their credit report. And they need to keep it under 30% too. That makes you both look good. That's a win-win.
It is. Just make sure you don't get added to a credit card where
they go downhill.
Because they're your scores.
Okay, just, hey, take me off. Call them up. Take me off. Cancel that. I don't need to be on your card no more. And definitely keep up with them. You know, some people, we think they're doing well, and they hit bumps in the road too. You know, and so if you know that maybe they've lost their job or they're hitting a rough patch, you know, it's okay, especially if they're a good friend or a family member, to say, hey, you know, I know you put me on that card and I just kind of wanted to check, you know, because I'm thinking about buying a home. And is that under 30%? If it's not, can you go ahead and remove my name from that? Because I have to stay in a certain range. And it's okay to have that conversation.
That is sound advice.
So next, because we are moving right along, I just mainly want to talk about the component, because you touched on it briefly, about credit. What you actually look for. We know they need to keep under the 30%.
Yes.
Are there any other special areas that they need to work on or stay away from?
Yeah, so when we pull credit, we will look for if you have any tax liens, any judgments against you, whether it's the IRS or maybe they have a civil judgment against you for maybe bankruptcies, bankruptcies, charge-offs, collections, student loans.
Oh yes, that's definitely.
So when it comes to student loans, if you don't have a payment, and we all say, oh, we don't have a payment because it's being deferred, we still have to account for a payment, even though it doesn't show up on your credit report. So if you're applying for a home loan and you're applying for an FHA, which is the Federal Housing Administration loan, or if we're going to do a conventional Freddie, then we only have to account for 0.5%, but it can make a difference in your payment. For Fannie Mae, we have to account for 1%. So what does that mean? If I owe $10,000 in student loans, I have to account for a payment of $50.
Okay.
If it's a Fannie Mae loan, don't have to account 1%, then it would be $100.
Okay.
Okay. So something to keep in consideration. When it comes to late payments, a lot of lenders don't want to see late payments in the last 24 months.
Okay, 2 years.
2 years.
24 months.
It doesn't mean that you're going to be automatically denied. You'll have to explain what happened.
What happened?
People know, and individuals know, companies know that life happens. So some things are beyond our control, and we just need a letter of explanation to explain to the underwriter what happened.
And I'm glad you brought that up, because I also had that experience with a client. We know that we've all experienced the shut-in of 2020. That's what I'm calling it. We gonna get past the pandemic. It was the shut-in of 2020. So some of us had to be deferred, weren't able to work. Some of us took the option after the first 60 days to continue not to work and to receive assistance. Yes, you had an income, but when it comes to applying for a mortgage, they want employment history of 2 years minimum.
Yes, we can't use unemployment as income. It has to be earned income, whether you're self-employed or W-2. So it's very important. Now, they will want a letter of explanation for if you have any gaps in employment. And they want to see that you've been back to work for possibly at least 6 months or so. So there's a possibility as well that they may do a proration of the income you've earned. So what does that mean? They want to see at least 12 months of history. So maybe I've only been back to work 6 months, depending on the program. And if you've only been back to work for 6 months, they may say, all right, you have 6 months of income, but then they're going to divide it by 12, which could decrease your gross monthly significantly. So maybe I made $30,000 in 2021. In 2022, I was out of work for 3 months. Now you've been back for the last 4 months out of 2022. Well, it would be very difficult. There's a possibility that you wouldn't qualify for that full amount. They may take that 4 months, or they could go back to 2021 and they'll do an average. So they'll take an average over 2 years. So maybe you've made that 30,000 in 2021, and maybe you've only made 10,000 in 2022. Well, you add them together, that's 40,000. So they'll take that 40,000 and then divide it by 24 months.
Okay. And that will give them their average.
And that would give them the average
of
income.
your income.
We use gross income, not net income.
Gross.
So we use the gross income, any income before taxes are taken out of your check.
And putting a pin there as well for my job jumpers. You have to be in the same field. So if you're a nurse and maybe you've been working in the hospital, but you transition to go to work into a nursing home, you're still nursing. But for those of you who are working in a factory, and then you change and you go to hotel work, you've changed your industry. So it's very important for that 2 years of employment that you stay within your industry. More importantly, stay within that same job. They want to see consistency. It's as if you're going to going for the job interview. Let's just put it briefly. When you go for that job interview, they're looking, oh my goodness, he left this job. He was only here for 30 days. And then he was here for 6 months. It's the same with the mortgage company. They want to see consistency because they're trying to believe that the money that they're going to give you, you're going to pay back.
That is correct.
And so it's just a value system. And so if you really truly want to get involved and want to own a home, it is very important to have job stability.
Stability.
At least 2 years.
Yes, they want to see you have stable income because they're putting the money on the line.
Putting the money on
Another
the line.
thing that we didn't talk about also is child support.
Ooh.
If you're paying child support, we have to count that against your debt to income ratio. So it's like an expense. But if you're receiving child support or alimony or any kind of support like that, as long as you're going to receive it for at least 3 years, we can count that income. And that can help you qualify for an additional increase in the purchase price of your home.
Now, what about those paying child support?
Paying, that's considered like I said, an expense. So we have to count that against your debt to income ratio. So you have to be aware of that when it comes to child support. I've had situations where borrowers were ineligible due to the fact that the child support put them over that limit.
And you must be current.
Yes.
That's the word.
Yes.
You must be current if you are paying child support. Then that sometimes people get frustrated and whatnot, and they, personal reasons have stopped paying child support. Many different reasons why a gentleman has stopped paying child support. But if you are interested in purchasing a home, make some arrangements. This is part of the credit building. This is one of the steps while you're building the credit. Get in touch with the child support bureau. Make arrangements, because what they can do is set you up on arrangements for the arrearage while you get consistent with the current monthly amount due. And I've seen that happen. So that's a part of your credit building.
That is fantastic. Also with the IRS, you also have to be in a payment plan as well and have made 2 or 3 consecutive payments before you are allowed to purchase a home as well, unless you pay the entire thing off. But they will want proof and documentation on that as well.
Now, while I'm sitting here thinking about it, bankruptcy. How many years do you have to be out of or discharged from a bankruptcy for a home loan?
That depends on the circumstance and the different programs. So it could be anywhere from a year to 4 years or 7 years. It all depends on the program, depends on what kind of bankruptcy, and depending on what kind of home loan that we're actually looking into. There's some exclusions, or they make some exceptions when it comes to bankruptcy, but everyone's situation is different. It all depends.
Well, I hope that you all grab some of these nuggets that Roland has dropped today, so that you can work toward building your credit, so that you can get a home loan. It's building wealth. It's establishing a legacy for your children and your grandchildren as well. Before we go, I'm going to have him give you his information. As I said, he is a mortgage pro. He is someone that I come to often through text and phone call and email and get information, because I'm working with clients. The mortgage process is not my specialty. Home shopping is my specialty. I take you to shop for a home. I know the ins and outs of that part of it. So I want him to give you his information.
Well, thank you, Bridget. You're so kind. So my information, my telephone number is 702-210-2057. That's 702-210-2057. You can call or text me. Email address is Roland, ROLAND, and another D for Daniels, at PRMG, that's PRMG.net. Very simple to remember. Thank you, Bridget, for allowing me to come on the podcast.
No, I thank you.
Please reach out to Bridget. She's an expert when it comes to real estate. She will be more than happy and willing to help you. It's very important you find a real estate agent that works with first-time home buyers and you feel comfortable with. She's been absolutely fantastic. So please give her a call, reach out. I'm always here for you. And so is Bridget.
All right. So we're going to close out today. I look forward to our next podcast. Hope you stay tuned as well. We are going to keep it coming. We are going to educate as well as elevate. We want you to get sucker free with me, BrandB. Have a great day.